Welcome everyone to the channel, and in this video we're going to be talking about fair value gap displacement models. So I'm going to show you how to filter out bad fair value gaps. So I use two filters, and I use this in conjunction with my model. Now, I'm not going to talk about the model itself, but I'll show you what it is. You can take a screen grab, a screen image, and this is it. These are the steps I follow, and it's called the two-step model. Now, what this model does, it tells me where and potentially when to take a trade. Let's use an example. So first, I'm looking at gold. Ignore this indicator. That's because I am working on building a indicator. So I'm in a test phase. So it's not out yet. It's not live. It's just a test. And I thought, let me create this video talking about fair value gaps. So how do you find the fair value gaps that effectively work? So using this example, the first thing I need is a bias or a directional bias. These are the same things, but slightly different. So to explain it, I need to explain what my model is doing. So first, let me remove this and show you this, right? So what is a directional bias compared to just a standard bias? So a standard bias is simply a trend. So you take your price or your candles over a certain period of time. That could be 21 days, 100 days, 50 days, etc. And you just add a average, right? That will show you the trend. And based on that trend, you can determine what your bias is. So for example, people will use the 200 EMA, and if price is above that, they have a bullish bias. And if price is below that, they have a bearish bias. So that's basically bias in general. A directional bias is more based on price history. Now, I use the model called a two-step, and it identifies 3 points: point A, point B, and point C. So I am only looking to take a trade at point C, but my directional bias is based on point A and point B. So hopefully that clarifies what I mean by a directional bias versus a bias. In either case, you're going to need a bias. This prevents you from taking every single fair value gap that you see, regardless of if it's bullish or if it's bearish. And by the way, you need these things in any time frame. Okay, any time frame. In this example, I'm using the daily. So we are live, so I'm just going to use a recent example. So let's say I've identified my point C, so I know where I want to trade. So let's say it's right here. Okay. So what am I looking for next? So remember, I have a directional bias. I've ticked that box. The next filter you need is a displacement with a fair value gap. So let me explain this. So on the internet, displacement can mean one candle or a series of candles. I don't subscribe to this definition. For me, displacement is just one candle with a fair value gap. Now, in this example, we have right here, I'm going to hopefully get an arrow. Yeah, this candle is a displacement candle. So remember, I already have a directional bias. I want to short, I want to be bearish, etc. I know where I want to trade, but I still need to know when. So first I'm looking for displacement. What does this candle look like? What are the characteristics of this candle? Well, it's simple. First, the candle must be a wide range candle. It cannot be a narrow candle. It cannot be extremely wide. It's just a regular wide candle. The second, it cannot have extreme volume. So again, just regular volume, average volume is good, high volume is good, but it cannot have extreme low volume or extreme high volume. So those are the two characteristics you need with a displacement candle. So again, it's just one candle. Of course, the next thing you need to see is a fair value gap. Now, in this example, if I do this, you can see that the fair value gap is not obvious. I'm going to remove this experimental indicator I'm working on. So you can see this. You can see no fair value gap. However, the fair value gap is actually hidden. When you have wicks like this to the left and to the right of a displacement candle, so it has to be a displacement candle. When you see wicks like this, it's basically hiding the fair value gap. So what I do is I manually draw on my fair value gap. And once I have these two things, I can move to price mechanics, right? And this is where you decide your entry, your stop loss, and your targeting. So I do this based on my model, and you might have the same or different type of model. In any case, um, going forward, what I've done is I'm working on this new indicator called the IB. And the IB basically is it's called the initiation block. It's not live. It's currently just in-house, and I'm testing this. And what it does is it identifies equilibrium. Okay, I'm not going to bore you with the details, but why am I now using this? Well, basically, I use it like an extra confluence. I already have my checks as part of my model, so there are certain things I am already looking for. But now I've added the IB, so what I'm looking for is an IB at point C. And then once that IB breaks, that indicates to me the direction price wants to go in. So remember, I've already done my filters. I already have my bias and I already have my displacement. So I already have those two. So adding an extra confluence gives me extra confidence, right? So I've been saying for weeks now, I've been short, or I want to go short on gold, and my target, which is based on the daily, is 3,500. So that's where I think ultimately gold will go. And this is not a session-based type trading; it's more swing or positional based trading. Okay, so hopefully you've got something from this video or just some insights. Now, if you did, please like the video, and if you want to see more videos like this, please subscribe to the channel. It will be truly appreciated. Thank you very much for watching. I'll see you in the next video.